I want you to imagine stepping into a room of electric tension. On one side, institutional giants quietly mobilizing. On the other, retail traders riding waves of fear and hope, all centered around one force: crypto. Over the past few days, we've seen that scenario play out in dramatic fashion. This is not just volatility for volatility's sake. This is a crossroads moment where regulation, macroeconomics, and adoption are colliding, reshaping which narratives survive. It all begins with a brutal purge. In September 2025, the crypto markets were hit with a wave of liquidations. Over $160 billion of value wiped out in days, the worst in months. Many leveraged long positions were crushed, especially on altcoins. Bitcoin slipped under $110,000. Ethereum dove nearly 6 to 7%. Solana dropped even harder. XRP, Cardano, Dogecoin all felt the pain. The intensity of this sell-off signals a reckoning, not just with price, but with the appetite for risk in a world awash in rate uncertainty. Against that backdrop, here's what's happening now and where the next inflection points lie. Now, let's walk through each of the 6 major cryptos I promised you, not in isolation, but as threads in a larger tapestry. Bitcoin, as always, remains the market's heartbeat. During the recent correction, BTC fell by more than 2% in 24 hours, pulling back from its August highs near $123,000. Some analysts see this as a healthy consolidation after an over-leveraged rally. Many leveraged longs were forced to unwind, accelerating the drop. But the deeper story is that BTC is increasingly the gauge by which institutions measure crypto risk. On the institutional front, one of the most consequential developments is the US SEC's decision to streamline approvals for crypto ETFs. Under new rules, ETFs, not limited to just Bitcoin and Ethereum, may soon flood the market. Some of the first new products are expected to include exposure to Solana and XRP, broadening institutional access. That means BTC's dominance may face structural downward pressure over time. Add also the strategic crypto reserve policy in the US. Via executive orders, the federal government may accumulate cryptocurrencies as part of seized asset stockpiles, including BTC. This gives a kind of official imprimatur to Bitcoin as a store of value asset with geopolitical significance. Technically, Bitcoin's near-term trajectory hinges on whether it can reclaim support zones around $112,000 to $115,000, and if it can push back toward the all-time high zone above $130,000. If it does, the path toward $150,000 may open by year-end, especially if macro risks, inflation, tighter Fed, ease. But if BTC loses key support, a deeper fall toward $90,000 to $100,000 can't be ruled out. Ethereum's recent performance has been rougher than BTC's. It dropped 6 to 7% in short order, contributing significantly to that $160 billion wipeout. But ETH has more moving parts. Its fundamentals remain anchored by active DeFi, smart contracts, and developer activity. One compelling development is technological acceleration. Researchers have proposed new architectures like the EVMX, an FPGA-based execution engine, which claims to reduce smart contract execution time by 61 to 99% and can make Ethereum-compatible chains much faster. If hardware offloading of smart contract logic becomes viable, ETH and its EVM-based rivals could get a serious boost in throughput and efficiency. Institutionally, the loosening of ETF rules by the SEC means Ethereum might see renewed inflows. But ETH must also prove its revenue model in a lower fee and more competitive smart contract space. Its August revenue reportedly declined by 44%, a red flag. But positive metrics like rising daily active addresses and developer commitments suggest the underlying ecosystem still has resilience. The key for Ethereum is whether it can stay central to innovation in rollups, zero-knowledge proofs, and scaling. If it does, ETH could reclaim strength and close the valuation gap against rivals. But if investors lose confidence in its revenue or scalability path, ETH may drift while more aggressive chains steal mindshare. XRP, often underestimated, XRP finds itself front and center in this market cycle. It has suffered alongside other alts in the liquidation wave, but XRP's value proposition, cross-border payments, partnerships with financial institutions, regulatory clarity in select jurisdictions, grants it a unique niche. With the changing ETF regime, XRP may be among the early beneficiaries. Some analysts expect the new US ETFs to include XRP as soon as October, which would open it to institutional capital previously shut out. That could be a catalyst for a strong bounce. Additionally, XRP patterns have shown repeating technical cycles over the years, and some observers forecast that XRP could revisit double-digit valuations, i.e. over $10, although that's speculative if macro conditions turn tail. One risk for XRP: regulatory headwinds globally. Though it has a bit more clarity than many altcoins, any adverse rulings or crackdown in key markets, like the US, could undercut its narrative. In summary, XRP might be undervalued in the current environment. If it captures institutional flows and keeps up partnerships in emerging markets, it could punch above its market cap weight. Solana arguably took the hardest beating in recent days. In one report, SOL fell more than 21% over the week, trading near $196. The drop was magnified by leverage positions being unwound. Yet Solana also offers arguably the highest beta among the major infrastructure chains. When sentiment turns, SOL often leads the upside. SOL's strengths are speed, developer traction, and high-volume activity in decentralized exchanges and NFT ecosystems. But it must continue to prove reliability and throughput under stress. The same new SEC ETF regime may also favor SOL inclusion, which could unlock inflows. Technically, SOL may face resistance around $215 to $220. A breakout above that zone could target $260 plus. If it fails, it may retest support in the $160 to $180 band. Solana's upside is appealing for aggressive plays, but downside risk is elevated. One wild card: with new hardware or hybrid execution models in the pipeline, if Solana can further optimize its network or integrate specialized execution hardware, it may sustain its high throughput promise better than many. Dogecoin is the wild card, always flirting between meme status and real liquidity. Doge was down alongside other alts in the downturn, losing 6 to 8%. But the community strength remains a differentiator. Dogecoin's network effect is real. In many trading flows, Doge is among the top traded coins, especially among retail. Doge is more sensitive to sentiment than fundamentals. If Bitcoin or Ethereum rally, Doge often leaps behind. On the flip side, in sell cycles it bleeds. For Doge to transition towards something more durable, it would need real utility integrations, payments, social tipping, tokenization, or backing by institutions. One interesting strategic factor: as ETF access broadens, Doge remains ineligible for many products but could still see spillover inflows when traders search for yield. But for now, expect Doge to behave like a leveraged proxy for broader bullish cycles. Cardano is one of the long-play bets among major altcoins. In the recent correction, ADA also fell 6 to 8%, but on-chain data suggests that larger holders, whales, have continued to accumulate. Some narratives see this correction as a clearing out of weak hands before a structural run. Cardano's roadmap includes upgrades in scalability, sidechains, and interoperability. If those materialize, ADA could transform from a niche stake ecosystem token into a serious infrastructure contender. But execution has been slow, and market impatience is mounting. One structural challenge: consensus power distribution. Recent academic studies comparing blockchains show that Cardano's staking concentration is more unequal than expected, placing some strain on decentralization narratives. Indeed, Ethereum's post-stake model also shows growing concentration. Still, Cardano's proof-of-stake backbone is efficient and mature. For ADA to excel, it must catalyze real user adoption, defy identity, tokenization, cross-chain bridges, and maintain institutional interest. If its momentum returns, targets in the $2 to $3 range might be plausible. However, if the broader market remains weak, ADA may underperform other altchains. This brings us to the broader landscape that's shaping everything we just discussed. First, regulation is shifting fast. The US SEC's move to relax ETF restrictions is a tectonic change. Cryptos that were previously non-investable for regulated capital may soon come into eligible baskets. This opens the door to capital flows into non-BTC/non-ETH names. We're already hearing anticipation of SOL and XRP inclusion. Suddenly, the institutional gate is opening wider. Second, stablecoins and banking integration are evolving aggressively. A group of 9 major European banks, ING, UniCredit, CaixaBank, etc., just formed a new entity to issue a euro-pegged stablecoin, expected in H2 2026. This is a direct move by traditional finance to embed blockchain rails in fiat systems. Meanwhile, thought leadership and research projects are arguing that stablecoins represent Banking 2.0, a rethinking of how money moves in the digital age. Transforming payments and settlements is now a battleground for crypto relevance. Third, the stablecoin realm itself is being rocked. Tether, maker of USDT, is reportedly planning to raise $15 to $20 billion via private placement to reach a $500 billion valuation. If it succeeds, that move could shift competitive dynamics in the stablecoin space and give Tether even more leverage as a base layer of the crypto economy. Fourth, at the macro level, traditional financial metrics are pushing back. Revised US GDP data showed 3.8% growth in Q2, and jobless claims remained resilient. That spurred a snapback in treasury yields and a stronger dollar, which put pressure on risk assets, including crypto. In effect, the market is now trying to time the next Fed move. Rate cuts could reignite risk chasing. Hawkish surprises could prolong the pain. Fifth, geopolitical and policy angles are now part of crypto's DNA. In the US, the idea of a federal strategic crypto reserve gives the market a pseudo-sovereign backstop. President Trump's executive orders to restrict CBDC issuance, revoke old digital asset mandates, and prioritize crypto innovation are reshaping the policy architecture. Meanwhile, in Pakistan, the newly founded Pakistan Crypto Council aims to provide domestic regulatory clarity, a bold move in a region often hostile to crypto. The world is remembering. Crypto is not just code, it's sovereignty. So, in this moment, the question is not if crypto will rebuild, but which narratives will dominate. Will the new ETF regime usher in a multi-chain institutional era? Will stablecoins become the plumbing of global payments? Will regulatory coherence coalesce or fracture? And which of our 6 altcoins will ride the next wave or get left behind? If the next few days see BTC and ETH stabilize, we may see selective alts like XRP or SOL launch upward leaps as capital rotates. ADA might surprise if roadmap developments get delivered. Doge will follow the mood. But if macro tensions stay high and regulation creeps into limitations, even the strongest narratives may be challenged. This is a crossroads. If you're investing, you must be vigilant, not just about price charts, but about regulatory memos, ETF filings, stablecoin policy, and institutional flows. The next leg up will not be a repeat of the past, but a reshaping of crypto's structure. Stay curious, stay grounded, and watch which stories get traction, because tomorrow, one or more of them may define the next cycle.